is John Piper. Back in 2006 I wrote this book, Financial Cataclysm Now, mainly because I believed that a bear market was due, and I wanted to get into print my thoughts on that. This video in fact is, if you like, the video version of the book, in that I again think a bear market is due. I think it's already started. So in this video I'm going to outline my thoughts about what we have to come in this matter. Alright, first let me define my terms. To me, a bear market really is defined by a market peak. So you take the DAX here, the peak came in here back in beginning of 2018, and we saw a peak at 13,595, and that defines the peak. Now I could be wrong, we saw an ABC decline here which suggests a corrective move, but ABCs can extend, and I'm not expecting this rally to make it back above this level up here. So that's the key point. So at this point in time, there's no real sign of a bear market. Now, if we take the 2007-2009 experience as an example, initially the news wasn't so bad, but the trend had changed in 2007. So if we look at FTSE, the peak came in July 2007, and the high was 6754. It was really only around later stages, after maybe a year or so, during 2008 to 2009, that things got really unpleasant, and then we got the peak, the low in March 2008. I was attending a seminar, in fact I was speaking at a seminar that month, and you could feel the fear in the assembly room, and that was the low. Now that was a legitimate bear market. You know, the market started off around 6-7, ended up around 3-4 thereabouts, so it pretty much halved. And that was and off we went again. And although FTSE has underperformed other markets, it is currently above the level of the peak in 2007. Now that's a bear market, but it wasn't really a savage bear market. It seemed so at the time, but the recovery has been pretty quick. Now there are examples of bear markets which are much worse than that. And in relatively recent times, this event, which started in 1929, so 90 years ago, ended a few years later, decimated the Dow. I mean, I can't remember the exact figures, but I think it ended up at about 90% down, so a savage bear market, which took years to recover from, which caused the Great Depression, or maybe that's not quite true. Actually, it didn't cause the Great Depression. It was all part of the same. It was all part of the same situation that led to the Great Depression, that also brought the market down. And we can talk for hours about the causes of these things, but one cause is certainly government policy at the moment. I mean, that's a given. We'll be touching on that later on. But my view is that these things are generational. That you don't get an event like the Great Depression until all the people who actually lived through it and had some understanding of it at the time, i.e. in the 30s, are dead and are no longer functioning. And then these events repeat, because people having been through it make darn sure it never happens again. But of course now, none of us are familiar with that event. So we don't know what we might now be facing. And I think this one is a more serious bear market. Hopefully I'm wrong on that point. And even if I'm right, hopefully it will be nothing like as bad as the Great Depression. But I think there are worrying signs in the world, and I think certainly the major fiat currencies, pound, dollar, euro, especially the euro, have gone past their tipping points really. You could easily see accelerated downside, especially when the government reaction to any kind of slowing or whatever is to just pour more money into the system. And I can see that the currencies are just going to collapse in this coming period that I'm talking about. Now let me just quickly go through my record on calling for major peaks. In 1987 I actually just started trading, but there was a perfect A8 wave pattern, which I will post later because I can't locate it right now. And I was heavily short into that particular crash. Didn't trade it brilliantly, but made a very healthy profit on the first day. It was quite a short-lived crash, in fact. The first day and the first 2 days, Monday and the Tuesday, were the majority of the move, as I recall. In 2000, the peak we saw here on FTSE, I was I gave a couple of speeches, one in Manchester for Charles Schwab, I think, and one in New York, calling for peaks in these markets, which duly came in on New Year's Eve 1999, the most bullish day of the year, most bullish day of the decade, in fact, or the century, as people celebrated the 1,000 years just past and looked forward to the 1,000 years to come, which of course we're now in. It started up and it's been going quite well at this point, although FTSE's been lagging, as I said. 2007, I wrote the book Financial Calculus Now the year before, and this video is my attempt to claim that the bear market has begun and what to expect from that bear market. Right, let's start with house prices, UK house prices. Very clear Elliott 5 here. 1, 2, 3, 4 and 5. It's possible that the fifth wave is not yet in, but it's very close if it's not actually in already. And we do have some equality here with wave 1 taking up to about 7,000, so it's a 6,000 point move, and that's about what we're seeing at the moment on wave 5. So often waves 1 and 5 are equivalent. Wave 3 is the longest, which is went from around 1995 up to 2006 when the last bear market hit. So I'm anticipating something a lot worse. I would think we're certainly going to revisit the 2008 lows, so a substantial pullback in property. We could easily halve, in fact. I would think that would be quite likely. So you don't want to be overexposed or certainly over-geared up to property at this time particularly. The market's fairly robust at the moment, as I understand it. That may not last too much longer, so it's quite important, as I know many people do have a lot of money in property. It's obviously been a very good investment over the last 50 years. This chart goes back to 1953, year of my birth, in fact. I was very active in the property market from around 75 till about, I think 87, I sold my place in Sussex. So I caught this one beautifully. I was a bit involved here, but not too much, mainly because I moved abroad. So I missed out on most of that move, but I had other things going for me at the time. And now I just have a very small investment, which with no mortgage, so there's no debt involved. But this is a major one, I think. I think that this could be quite a nasty bear market for people who are either over-invested in property or over-geared in property. So where's a good place for your cash? Well, I believe precious metals are the safest places to be. And I mean, gold's still low there, 5 waves up, which is the Elliott wave pattern again. A, B. It looks like the C wave may have further to go, but I think 1260 is probably pretty solid support, and then I think we're going to see a solid thrust up in gold. But that probably includes silver. Platinum also looking good at the moment, so I recommend that for one thing. For people who actually want to invest smaller sums in gold, and a company called Carrot Bars does sell pre-packaged gold, and you can do a standing order of so much per month if you want to. I think it's quite a good way of buying gold, and actually it comes in a credit card, embedded in a credit card, which I think is quite a good way of medium of exchange. Fiat currencies do become devalued, having some gold around could be a lifesaver, in fact. Gold mining shares, another avenue where you can see a gearing to the price of gold. So you get where gold might double, a mining stock might quadruple, or even more than that. However, initially, there will be times during the bear market where stocks decline generally, and gold stocks could easily fall foul of that to an extent. I think it should be short-term effect, but it's worth bearing in mind that if stocks start falling, then people may be selling stocks indiscriminately, and that could affect gold stocks obviously as well. As far as currencies are concerned, this is really what I expect to see. And this actually is the devaluation in the Roman denarius 2,000 years ago, when the Romans simply started off with about 90% silver in the denarius, 90% plus around here, and they just kept reducing it till there's virtually nothing left. So the valuation of 99% was created simply by removing the silver. These days the governments just print money, same effect really. Price is a function of supply and demand. You just keep increasing the supply again and again and again, then the price just goes down, down and down and down. Well, this chart shows the same thing with the dollar. Up until the Fed got involved back in 1914, the dollar was fairly stable. A couple of blips. I mean, the Civil War was a bit of a blip, but basically it was going sideways, which is what you want. You want stability in the currency. As soon as the Fed got involved, it had this rather erratic heartbeat, as it were. But eventually, Nixon, of course, was the final blow when Nixon took the dollar off the gold standard, and it's now fallen about 80% so far over the last 40 years or so. And I believe that trend will accelerate during the next few years, and that paper money, or at least the fiat currencies, will lose a lot of their value, which has, again, very important consequences. I mean, that is the case, then you need to have spending money, you need to feed your family, you need something, an alternative. So gold is one, the cryptos are another, and I think this is where cryptos can really come into their own. But cryptos will be, I think, have an erratic ride. I mean, people are desperate for cash, they'll be selling everything in sight to get cash. You know, if house prices fall, interest rates go up, for example, they've been very, very low for a long time now. That may not survive this coming bear market. Remains to be seen how the governments play it. I mean, they may well keep interest rates low because nobody will be able to afford to pay them if they put them up, which is, I guess, a fairly important point. But as currencies are devalued, people will be looking for better forms of exchange, like they are now in Zimbabwe and places where Venezuela, where the government currency is just worthless. So people turn into cryptocurrencies and gold, you know, which have a much more stable value away from government interference. And it is interference. You know, the governments these days are way out of control, do far more than they should do. And the end result is not to be a pretty sight, which is what I'm talking about in this video. All right, that really covers the ground. So I may well re-record this, but I'd like to receive some comments on the initial effort, as it were. And I hope you found it interesting and useful. Please feel free to make any comments. I'd be interested in hearing what people have to think. And thank you for your time. Bye for now.